Hello, hi everybody. Okay, please give me a few moments. Apologies for the delay. Busy schedule as usual. Um, okay, I see people joining in. That's very nice. Welcome, guys. See Joshua. I see Ryan. I see Eagle. I see Maria. Welcome. People still keep coming in. Perfect. Okay, so let me see if I have my chat settings up and running correctly. Can you please type in the chat to let me know whether you can actually communicate with me? That would be nice. Whether you can see the first slide of the presentation, it reads technical analysis and technical indicators, and these are the basics. Please give me a thumbs up to get things started. Can you hear me loud and clear? That's another question. Whether you can see me or not, that's irrelevant. The point is if you can see the slide and you can hear me and you can chat with me, that's it. Other one is extra. So, okay, thanks for the confirmation, Ryan. Thank you for the thumbs up, guys. Okay, so welcome to another episode of our lovely series. Today we're going to do not going to be a super deep dive into technical analysis. It's going to be more or less super basic and more like an introductory kind of session. Okay, this is for you to get familiar with these kind of indications. We're going to go over the most widely used ones or the most well-known ones, at least super easy to comprehend, understand, interpret, and then apply to your chart and actually go ahead and make informed decisions based on what they're actually telling you. So today we're going to go over, if I'm not mistaken, moving averages, RSI and Bollinger Bands, a pretty diverse trio of technical indicators. They give you a lot of information that if you get some sort of confluence or that tell you pretty much the same thing, or at least they kind of align, you get pretty significant kind of signals for you to go ahead and actually trade upon them. Okay, so okay, still people joining in. Welcome, guys. Okay, since we are almost 10 minutes late, I'm gonna go ahead and start. And if you guys have the ones that actually joined, if you have any sort of questions, please send them through in the chat. If I'm talking way too fast or way too slow, let me know. I'm gonna adjust accordingly. For the time being, let's kick start the whole thing. Okay, so webinar. I'm not sure what kind of number it is. It's been a few of them, so probably 10, 12, something like this. So technical analysis, technical indicators more specifically, and these are going to be super basic. Let's go. So this is a quick risk warning and a disclaimer. I'm not going to go read it out. You can read this at your own time. Essentially, the gist of it is that this material is just for educational purposes only, and it's not providing any sort of investment advice or investment recommendation. There's no anything contained within this kind of document that does so. So this information is strictly prohibited for your educational purposes only. Okay, so and the redistribution is strictly prohibited. Okay, so let's go ahead and start. So what we will go over in this kind of session. So this is the agenda for today. 4 points and one summarizing it in a sense. So we're going to do a brief intro into technical indicators for those of you that have not watched any sort of webinar we've done so far. This is going to be a super basic introduction, excuse me, of what technical indicators are if you're not familiar with the term. Then we're going to go over into moving averages, Bollinger Bands, and RSI, the relative strength index. And finally, as we progress and go over each and every one of those three, we're going to say how to interpret them. Okay, so this is the point of the webinar in essence anyways. So what is technical analysis? So introduction to technical indicators. More specifically, the technical indicators fall under the umbrella that I've came up with. There's many different ways to categorize this kind of information. The information is the same. The categorization kind of varies between who is presenting the material or not. So mine is that we have mechanical analysis, which is something in a sense you do on top of your chart. So you see this split off on your right hand side of the screen. So we have charting analysis and mechanical analysis, two branches in a sense, broad branches of technical analysis, this kind of school of thought. that takes into consideration past price action, volume, open interest, and all that kind of stuff. And you make informed decisions based on past price action and try to identify patterns, define the current direction or trend of the market, and you go ahead and do whatever you want to do afterwards. So you have two branches, charting analysis and mechanical analysis. So charting analysis is you are essentially going on top of price action, whether you have a line chart or a bar chart, or you have a candlestick chart or a pivot point, or whatever that is. You conduct technical analysis, charting analysis more specifically by drawing trend lines and identifying the trend. Okay. So you draw your channels, you place your support and resistance levels, in a sense, areas that you see price action stalling out or breaking out from. These are key areas that have played a major role in the past of that specific instrument's history, if you would like. And that's why we call them as important, because mainly in the markets, you tend to see that the past tends to repeat itself. So therefore, we take these levels as important and we extrapolate from there onwards that we may see, it's not for sure, that we may see some sort of support taking place at that level or some sort of resistance at that one, depending on the situation. Okay, so support and resistance levels. If you are not familiar with the concepts, we have a webinar you can watch it on YouTube, which clearly defines what support and resistance levels, how to place them correctly, what are the importance of using those, how to use them, how to plot them on your chart, etc., etc., etc. So this falls under charting analysis. You also have the identification process of chart patterns, or identifying individual candlesticks and what kind of information they convey. For example, a common pattern that you could see is a morning star or an evening star, where you see some sort of reversal taking place with dodgy candles at a full. We're not going to go into detail into this. We have covered this many times in the past. Let's focus. So charting analysis, in a sense, you go on top of the price action and you draw, or you may draw clearly defined lines or curves that are serving the purpose of validating the fact that the trend is moving at one direction or the other. And once that direction or those lines are broken or tested or whatever that is, you switch your assessment accordingly. Okay, the reason why you use those lines in the beginning is for you to have a clear set in line, or at least a goal that, you know what, I'm gonna use this information in a structured way in order to place my trades. You can use trend lines in order to identify the trend, and use support and resistance levels in order to mark the entry point and the exit point accordingly. Okay, again, we're not going to go into this. We've covered this many times in the past. Let's focus on today's session. So it's going to be under mechanical analysis. So the second category again, and this what we call mechanical analysis in general is, in a sense, the usage of technical indicators. You're going to see what technical indicators are. Some examples are moving averages, oscillators, envelopes and bands, and other technical indicators. I have many out there, excuse me. Now, which ones you pick and choose and use accordingly, this is up to you. The point is, if you do understand what information they are conveying, excuse me, guys. Thank you. Okay. Sorry for the small delay. So yeah, technical analysis, more specifically mechanical analysis, uses technical indicators. The ones we're going to cover today are moving averages, RSI, and Bollinger Bands. Fall under these three broad categories or points that you have on your chart. Okay, so mechanical analysis at the end of the day is performed by the usage of, as we just said, moving averages, oscillators, envelopes and bands, and other technical indicators. And the aim of the technician, that person, guy or girl, that uses this kind of methodology or this kind of approach of technical analysis, using mechanical analysis in a sense, is to establish the market sentiment by the help of these kind of pre-mentioned tools. They're not giving you actually direction of the market. They're telling you how strong a move is, how much momentum is behind it, whether a move is extreme or not, where you're going to see some sort of reversal taking place, depending on the indicator you use. So these are more calibrated, what would you say, pre-manufactured kind of tools that you're not going to go ahead and just calculate anything. You just select the indicator and you place it on your chart and it spits out the information. The only thing you have to keep in the back of your mind is that the settings of each and every indicator do matter. They do have an importance, but for the time being, we're not going to go into much specifics. We're going to introduce the possibility of using these kind of indicators with the purpose of making much more informed decision. Okay, so technical analysts or other, in other words, chartists, look for and employ or adopt to the charts, if you like, technical indicators, and they use it on historical asset data to judge entry and exit points. We have talked about this. So there are several technical indicators that fall broadly into two main categories: what we call overlays, so on top of the price action. An example is with the moving averages in the bullish band, and oscillators, which are, as the name suggests, they oscillate or they move up and down on a different panel below your chart. So, for example, moving average, convergence, and divergence, MACD as an indicator, it goes below your chart. It's not going to be on top of the price action. Okay. Momentum is also going to be below. RSI is going to be below, and you have many, many others that are on a separate box below because they don't have pretty much anything to do with the direction of the trend, but rather they give you how strong a cycle of up and down is. Okay, how much momentum is, how much, what's the sentiment of that or surrounding that instrument is. Okay, these are the stuff that mechanical analysis tools or technical indicators are telling you. Okay, so technical indicators, also known as technicals, are focused on trading data, and this is the important part. What components do these indicators have? One is price, second is volume, and third is open interest, and you have different indicators for each and every one of those. And technical indicators are commonly used by, indeed, active traders for the majority of the part, since they are designed to analyze super short, and medium-term kind of movements, but also what we call not carry traders, long-term or long-term holding kind of traders. They do use, they should, I'm not telling anyone what to do, but it's in their benefit to use technical analysis as well in order to keep track how their positions are evolving over time. Okay, so they might not be spending as much time as a day trader or a scalper is in regards to conducting technical analysis. They may be using, we're talking about long-term traders here, they may be using technical analysis on a kind of on a weekly or a monthly kind of basis, depending on the horizon they're actually trading, in order to gauge where the market is moving, whether they are actually in the right trade, whether the trade is worth having or whether it's time to close the trade, depending on some sort of signals that their indications, the long-term indications, are telling them. Okay, so enough blabbering, let's move on. Types of technical analysis, as we said, mechanical analysis is, again, as another split off between on chart and off chart. Just mentioned this. So on chart, we have Bollinger Bands, moving averages, the two we're going to discuss today. Also, we have Ichimoku clouds. Super sophisticated, yes, you might say that. Super sophisticated technical indicator. There's a lot of parameters going into there. We were going to do a super deep dive into Ichimoku clouds. Super interesting, at least from my point of view, of how they work and what kind of information they're telling you. Another one is parabolic saw. I don't think we have covered this so far. Maybe we're going to do that in the future. Also goes on top of your chart. And we also have the last one, let's just say, out of the many, the Fibonacci extensions, expansions, and all that kind of stuff. Okay. Again, all of these, you will not be manually, let's just say, you will not be concerned with inputting data manually in order to keep up and have information regarding these kind of indicators. The system has them already inbuilt. What you need to do is just adjust the parameters accordingly. Okay. Off chart, the other category, you have RSI. This, again, the other indicator that we will discuss today. Also have moving average, convergence, and divergence, the MACD, the ADX, the ATR, momentum. There's a bunch of them. Okay, so these are the ones you see in front of you right now as a whole on this kind of slide. Most of them we're going to cover in upcoming webinars. Today we're going to do intro, moving averages, Bollinger Bands, and RSI. Let's go ahead. So moving averages. What are moving averages? Super simple concept to understand. Okay, as the name suggests, you average something. Okay, you have an X amount of values. Okay, values being the close price, the open price, whatever that is. Most of the times we're talking about close prices of the X amount period of times in the past. Okay, so when we say we have a 10-day moving average, the period that you average out, the closing prices of the past 10 days are averaged out, and they spit you out, in a sense, a new value, which is a line. So if you have enough dots, you plot a line, and that's how you end up with a moving average. Now, the moving part of the moving average is that since this is an indicator that is a quote unquote dynamic in nature, most of them are, because they incorporate incoming information as we progress through time. Because again, at the end of the day, what we're doing with technical analysis is attempt to come to conclusions and extrapolations and assessments by looking at past price action. So therefore, we're looking in the past. Obviously, moving average is something else to keep in the back of your mind, is that it is a lagging indicator. Okay, don't use, please, do not use the moving average as an indicator that is giving you, let's just say, hints about where the price action is going to move to in the next 5 minutes, 10 minutes, an hour, a day, a week, or whatever that is. They are not future predicting. They are merely compiling information from the past. Okay, so this is the term lagging indicator. Okay, you use this mainly for confirmation. What kind of confirmation? Direction of the trend or a shift in trend that has already happened. Okay, so that has already happened. If you are actually paying attention on a day-to-day basis and you see indeed a split off point or a crossover, or let's just say a pivot from the current trajectory of any given instrument. And if you look at that on a daily basis or on a 15-minute or whatever that is, if you do pay attention on how the moving average is evolving at that point in time when you're looking at it, you may spot, or you could spot, or most of the times you do spot, these kind of divergences or breaks from the current trajectory. And these are the ones you are actually capitalizing upon after they have already happened. Okay, they are not telling you information about what's going to happen in the future. They're telling you information about what has happened in the recent but not distant past. Okay, so far so good. You following me? Yeah. If you have questions, please send them through. Okay, so moving averages is one of the most widely used technical indicator. It identifies if a new trend has begun. Notice the past tense here, has begun, or if an old trend has ended or reversed. Okay, we're not talking about the future, or it is not saying if a new trend will begin or an old trend has started. Okay, which is actually has started. That's my bad. So it's not telling you anything about the future. It's telling you about what has already happened in the recent past. Okay, so please digest this as soon as possible. They do not have predicting abilities about the future, these indicators. Okay, merely for confirmation purposes, pretty much exclusively. Okay, so it is the average for a certain body of data. So for example, if you have a 10-day average of closing prices, most likely is closing prices. You can adjust that. You can do range. You can do open, depending on how sophisticated you want your approach to be, or calibrated according to your needs. Most of the time, the default is closing prices. Okay, so imagine that you have 10 days. Those 10 days are averaged out, and you have a value. So tomorrow a new day begins, new information comes in. So the 10th day gets excluded from this calculation, and the new day gets incorporated. Okay, you understand what I mean? So you have a moving new 10-day period, or minute period, or hourly period, or whatever that is. It's not on a daily basis. It's on a time frame basis. So irrespective, if you're looking at a 15-minute chart, it's going to be the last 10 15-minute chunks of that data. Okay, if you're using a weekly chart, it's going to be the past 10 weeks of data compiled and gives you the moving average value of today. Okay, so it's irrespective of the time frame you use. The day there is just for convenience. Okay, so what else? The body of data to be averaged moves forwards with each and every new day, hence the term moving. Okay, we discussed this. By averaging the price data, a smoother line is produced, making it much easier to view the underlying trend. Okay, This is what we care about. This is the valuable information that this indicator is conveying, the direction of the underlying trend. And if you can see this chart on the right hand side of the slide, you have 1, 2, 3, 4 different parameter kind of moving averages. You can see the 200-day average, the 50-day, the 20, and the 10. And what you observe here is that all 4 lines are heading where? South. Okay, that means the current instrument that we have in front of us as a screenshot is losing value, is devaluing. Okay, so you have the direction which is clearly downwards, and if you could not have seen that with the naked eye, with only the price action, without the moving averages, you use the moving averages for confirmation. So all 4 of these lines, so we have a super short, short to medium, a medium one, and a long-term one, giving you the same indication that the market is heading south. Okay, this is the confirmation you need. This is information that is valuable, where what is given by the moving averages. Now you have different strategies of employing moving averages, a short and a long one, where you can actually capitalize upon this and, in a sense, swing or this is essentially what swing trading is. Capitalize upon the shifts of the cycle, and you can become, well, if you're doing it actually correctly, you can actually make a lot of cash doing this. Okay, so but before we move on, I want you to make a small observation of the relationship between these kind of indicators, depending with the length. So you have the 10-day moving average. As you see, the black line is closely and neatly hugging the price action. You can see it's already fitted near the price action, compared to, for example, the 200-day moving average, which is a smooth line that goes like this. Okay, so the shorter the moving average is, the more hugging of the price action it will have. The longer it will, the longer the moving average, the period that you average out, obviously is going to have much more deviation. It's not going to be as close as the other one. So this has implications, and this has benefits in regards to deploying a strategy using 2 moving averages, and we will discuss them. So where did we leave? We left off. Okay, yeah, a short-term moving average would hug the price action more closely than the long-term one. You can clearly see that. So the greater the number of periods used, the greater the smoothing. Okay, so there are 3 types of moving averages. What we call the SMA, the simple moving average. Again, 10 periods. You have 10 values. Divide that by 10. Done. Simple moving average. You have the linearly weighted and also the exponential moving average. Exponential moving average has become more prominent and more liked by the trading community, not recently, but it's been what, decade and a half now, because in simple words, exponential moving average, if you have 10 values, okay, the exponential aspect of the moving average, it gives much more weight on the much more recent kind of period. So you have 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10 days. So it places much more emphasis on the, let's just say, the last 4 days, 6, 7, 8, 9, and 10, whatever that is, 5. And it places much more weight or much more importance on the most recent kind of past day, for example, yesterday or the day before that. So 1, 2, and 3 days, let's just say, it gives much more weight, this technical indicator gives much more weight on much more recent kind of price action or closes of price action. It gives you a much more accurate, may say, or much more sophisticated, or a little bit more calibrated to how things are in the moment, rather than the simple moving average, which just takes 10 values and just divides them by 10 without weight. Okay, linearly weighted moving average is pretty much similar to the EMA. Hopefully I didn't confuse you. Hopefully that is understandable. What is the difference? The main difference is small, but still difference between SMA and EMA, but also DMA. Okay, if you do have questions, again, send them through. So moving averages. The moving average, again, is a follower, not a leader. Okay, so it follows the market and signals that a trend has begun, but only after it has happened. Okay. Nothing else to say here. So we have an example, a simple example of two moving average strategies. So you have only one moving average, not that sophisticated. So in a sense, when you have the market closing above the moving average, and again, remember the moving average is the past X amount of periods averaged out. Okay. So then the past X amount of closing prices averaged out, and you get the moving aspect of it as well. So when you have a fresh close in today's session, let's just say that you see the price action closing above the moving average line. Okay, this in a sense is a simple strategy of going, gives you the indication, a simple way of looking at things, of going long. This is considered to be a bullish signal. That means that today's price action has crossed a level that we haven't seen in the past X amount of closes combined. Okay, that means there is enough interest currently, or there is enough bullish momentum or sentiment surrounding that instrument in today's session because it broke above the X amount of period of moving average. Okay, so the opposite is also true. If you have an instrument that crosses within a day or within a 15-minute period or within an hour period, whatever that is, below that moving average line, this generates a sell signal. So essentially you go short, mainly because you have seen some sort of deviation between the price action of the past 10 days. And now you have some sort of movement, in this kind of case, negative. Therefore, you kind of capitalize on the expectation that the market is going to head south from here. That's why you sell. Okay. Super, super simplistic. No, not advised to go ahead and just trade purely using only one simple moving average and nothing else. Again, you're gonna understand as we progress through these kind of webinars the importance of using many different indications and seeing whether they are coming together or they're telling you different stuff. And given the fact that you have more information, you're gonna make much more precise kind of decisions going forward. Again, making the assumption that you know what information does each and every one of those technical indicators or charting tools are telling you. So interpretation here is key. Understanding what are the benefits, what are the strengths, and what are the weaknesses of each and every indicator, and making, in a sense, a team of indicators that complement each other, and they're not telling the same thing, but also looking for that confluence or the convergence of indications or signals of all of these indicators. Again, let's not rush. So the second strategy that we have with moving averages, by the way, there is plenty of them. We just chose two simple ones in order for you to get the grasp. Okay, so using two moving averages, when you have a short-term moving average and a long-term moving average, as you can see here. So for example, you have a 10-day moving average and the 50. Okay, so this is the short, the 10-day period is the short, 50 is the long. So when you see the 10-day period in this kind of example crossing above the 50 period, which is the long-term moving average, excuse me, in this kind of case, this creates what we call a bullish signal, okay? Because it tells you that there has been an intermediate or at least a short-term kind of shift in trend, okay? And it's about to, we are about to see the beginning of a pivotal kind of correction, you may say, or reversal, depending on the situation. So using two moving average, one small and one long, the crossovers between the small and the long moving averages give you indications. So when you have the small line, the short-term moving average crossing above the long-term one, that generates a buy signal. And when you have the same small moving average crossing below the long-term moving average, this generates a sell signal. Okay, in essence, this is pretty much it. Super, super simple, reliable, yes, efficient, super, yes, but at the end of the day, it's simplistic. Okay, it's beneficial to add more stuff to your chart and see that convergence yet again. Okay, so again, SMA above LMA generates buy signal, SMA below LMA creates a sell signal. That's all you need to remember. And this is a visual illustration of what we call with the two moving average as a strategy. Okay, so what you see here, the green line, obviously because it fits the price action much more closely, is the short-term moving average, and the blue line is the long-term. Okay, parameters depend on your liking. Okay, but the point is there is to be difference between the two. More significant, the better. So the green line is the short-term moving average, and the blue line is the long-term moving average. So you see here, the green line crossing below the blue line. So the short-term moving average has crossed below the long-term moving average, creates a sell signal, okay, which we call a bearish cross. So the crossover between the two. And in a sense, give you an indication that you need to the trend has shifted, and the market is now heading south. So therefore, you go short. And when you have what we call the bullish cross, this one is much more better. So when you have the bullish cross, where the short-term moving average, the green line crosses above the blue line, the long-term moving average, this generates a buy signal or a long signal. So from there onwards, it indicates that the direction of the market has shifted. The bulls are in control, and now they're driving the price action to high ground. So the best thing you can do, okay, if you spot this, is to go long and capitalize on the upside, okay? And you can clearly see without the moving averages that the market has reversed, okay? Because it starts from the top, goes to the bottom, and then once again surges, okay? Super stuff, super simple stuff, okay? And as you can clearly see in the middle, you have this bullish cross and this bearish cross close to each other, false signal, okay? Mainly because this has been the shift, the actual shift in the trend, okay? Moving south, consolidation, and then pivot and rebound to high ground, okay? This was an area. I don't know if you can see my mouse pointer. Can you guys see my mouse pointer? Hopefully you can. I'm talking about the two circles in the middle of the chart right now, okay? So bullish and bearish cross, the ones are next to each other. So this has been the area of reversal, okay? So this is the crucial area, okay? So that's why we await for the final kind of clear cut signal before we go into this. And plus here, we're talking about two moving averages only. We have not used any sort of technical indicators, other technical indicators, for example, RSI or moving average convergence and divergence, or support resistance lines or trend lines, none of that. We're purely using simple moving average, two moving average as a strategy. So imagine if you place all of this, and we're going to do that on a live environment in a few weeks' time, where we're going to go ahead and use all the stuff that we've learned and make this what we call, at least what I call, and I don't know if anyone else calls it, maybe other people do. What I like to name it as a base case scenario. So you take all the information together, you use all the technical indicators that you have available at your disposal after you've learned what any chain of information they convey, and come to make an informed decision using the information that you have in front of you. Okay, so you're not going to merely be using two moving averages and that's it. We're going to do trend lines. We're going to do support and resistance. We're going to identify chart patterns. We're going to use technical indicators, Bollinger Bands. We're going to do moving averages, RSI, MACD, all of that together to see what we thought when I say you see live with me in practice, to see what I'm talking about when I say I need to see convergence of indications before going long or short, okay? And then identify and entry and exit points. So we're going to do the holistic approach after we finish this lovely series of all these kind of indicators. Okay, so enough about moving averages. Let's move on to the next topic, which is what time? Oh, we have to rush. Which is Bollinger Bands. Okay, so this technique was developed by a guy named John Bollinger, super influential figure in the technical analysis kind of community. It came up with a lot of different indications and many others as well. I still, this is his tool named after himself. So this technique was developed by him back in the 1980s, if I'm not mistaken. So in a sense, what this is you have the price action and zigzags, and using Bollinger Bands, you get some sort of a band around it. So extra two lines that are around the price action, telling you whether a move has been extreme or not, or whether the market or that specific instrument is moving in a quote unquote predictable manner towards that direction that it's getting at. Okay. If you're confused, fear not, I'm going to explain, I'm going to elaborate further. Okay. So in a sense, the Bollinger Bands are employing two bands, which are placed around a 20-day moving average. The concept we have just introduced, the moving averages. So X period of time, in this kind of case, is 20. The default is 20. So you get the average of that, and then you add two standard deviations above and below. What are standard deviations? Is a statistical kind of concept or a tool that at the end of the day describes how prices, because we're talking prices here, are spread around an average value. So in a sense, what you need to know is that we have a common saying in the markets that the market tends to revert towards back to the mean. Okay, the mean means the average. So markets, yes, it's going to move to the upside, but then it's going to come back down and then consolidate and move up, back down. So in a sense, the reversion towards the mean, coming back to a middle line or an average line. The mean means average, by the way, in other words. So this standard deviation, this statistical concept is measuring or attempting to describe or confine the price action, how whether that move was particularly violent or volatile, or whether it has been deviating within a normal kind of bound. Okay, again, if I'm not confusing you, I'm going to elaborate further once again. So standard deviation is a statistical concept that describes how prices are spread around an average value. And by using two standard deviations, we're not going to go into the specifics of how the standard deviations are calculated. These are mechanical kind of tools that are already predetermined. What you need to know is that the reason why we used two standard deviations and not one or not three, which you could actually employ, by the way, you can do one standard deviation, 1.5, 2, whatever that is. The basic default settings for this kind of tool is that the two standard deviations, two acceptable extra layers in a sense of data, are going to capture the 95% of the price action is going to fall between these two bands. In other words, what we care about at the end of the day when we're using these kind of tools, the Bollinger Band, is that we do care about when the price action exceeds these bounds. Let me see if I have a visual illustration. This is the visual illustration in order for you to get your head around what I'm talking about here. So the 20-day moving average is the average line, the one in the middle. Hopefully you can see my mouse. Okay. This is the 20-day moving average, and you can see that pretty much you see price action revolving around that line, but sometimes it exceeds it. Okay, and then back once again towards the midline. Okay, exceeds, back once again to the midline, exceeds, okay, etc. So you have two bands, middle line or the midline plus two standard deviations. It gives you the line above it. Okay, so the midline minus two standard deviations give you the line below it. Okay, so the Bollinger Bands are encapsulating 95% of the quote unquote predictable or normal expectation of where the price action could gyrate around that kind of line. Okay, so what we do care about, however, when we use the Bollinger Bands are the areas. Give me one sec. The areas where you see the price action crossing above the 95%. So we're looking at the extreme, in a sense, 5% of the time that we had a volatile kind of move. And the reason why we look for that volatile 5% chance move is because we do expect, once again, the market to kick in to that good old saying that it's going to revert towards the mean. That's why we do care about this price action exceeding either above or below, because after that we can make a reasonable guess, and it is a guess. This is not a law written in stone. It's just an observation that whenever price action deviates a lot from its mean, then at some point in time, it's going to come back down towards to it. So in a sense, when we look at this price exertions above these upper bounds, okay, or in this instance right here, or this instance right here, clearly in this instance right here, okay, we do care about the fact, or what we are attempting to capitalize upon at the end of the day, is that the price is then gonna revert back towards the mean. Okay, so this is what makes it kind of predictable when you use the Bollinger Bands. In this kind of case, once again, exceeded and then kind of reverse back towards the mid. And you can see the midline is not a steady line. Okay, it's a dynamic kind of indicator because it averages information about the past. In this kind of case, 20 days moving average is this kind of line. So as we progress through time, new information gets included, and the furthest away from the 20 period gets excluded in order to get the moving average part. Clear? Yeah. Okay. So what we do care about is these areas right here, we just highlighted, in order for us to, for example, when we see the break above the upper bound of the Bollinger Band, we go short, expecting, yeah, terrible handwriting. Oh, that was no bad, actually. Better than most of the times. So we, in a sense, when we see these breaks above the upper bound, we go short in a sense, and we have some sort of target near the midline. Okay, so that's our signal. So when it exceeds above, go short. When it exceeds below, we go long or we buy. Okay. Again, capitalizing on the expectation that the market or that specific instrument's price action is going to revert back towards the mean, the midline. Okay, this is the concept in a sense. We're looking for those 5% of extreme cases that has been a lot of volatility to capitalize upon based on the scenario that the market or that instrument is going to price action is going to revert back towards the mean. Okay, that is it in a sense what Bollinger Bands are doing. No need to know the technical aspects of it, how the standard deviation is calculated and all that kind of stuff. Yes, it's nice to know those kind of things, but at the end of the day, what kind of how to use it as a tool, okay, is the most important thing. So 20-day is a moving average, okay, and you have 2 standard deviations or 2 SDs, in other words, how you will call it. So 3 standard deviations. If this was 3, if these 3 standard deviations, there we go from 95%, if I'm not mistaken, up to 99%. So you're going to be looking at a much more extreme kind of scenario. So if you do 3 standard deviations, the band is going to widen even further. Okay. And those moves that exceeded the 2 standard deviations are now probably going to be within the bound, and we're going to be looking at the extremist of the extreme kind of moves before capitalizing upon them. Okay, and so far everything clear, guys? Give me a thumbs up and we move on. So at the end of the day, something else to consider is that Bollinger Bands measure volatility. Okay, that's what you need to know. Moving averages are trend identifiers. Bollinger Bands are a volatility gauge. Okay, a measure of how volatile a thing is, an instrument is. Okay, so when the market becomes more volatile, the bands do indeed widen, excuse me, because we're talking about a dynamic kind of aspect of things. So the more volatile the price action is, the bands are going to get even bigger because it affects the 20-day period of the moving average, and you add on 2 standard deviations on top of that. So that's why you get the widening of the bands. So while during quiet periods, the bands do contract. And this is the example right here. Okay. So this is a period of what we call some sort of consolidation. So the price action was somewhat confined within that range for how long? February of 2016 until April. Or March, whatever that is. So month and a half, 2 months, let's just say, of stagnant price action. Price action has stayed within this kind of range, not going either upside or to the downside, maybe slightly downwards, but still overall, looking at this, that is a sideways kind of move. So you see the Bollinger Bands here, super close to the price action. So narrows down compared to this. After this kind of volatile move where you saw the bands widening, you see the distance between these two? Larger, obviously, than this. Okay, so the closer the prices move to the upper band, the more overbought the market is. That means there's super bullish confidence around this kind of instrument. And the closer the prices move to the lower band, the more oversold the market is. So this is for a reversal kind of purposes, technical indicator usage, if you would like. Okay. And finally, upper and lower bands can also be used as price targets. Again, as I just mentioned, you could go short up there and have the midline as your exit, or you expect and you await the next touch, the next break. And let me see if I have a clearer kind of example. Possibly here. Okay, so you go short there, briefly touched. It's not enough in my eyes, to be honest, but still mainly because it moves to lower ground as an instrument. Short bias is guaranteed for this instrument. So going short there, instead of having a target here, you could have a target down there where it exceeds the Bollinger Band. And this is another example. You see the price action breaking below, okay, the lower bound of the Bollinger Band, but not reversing back towards the mean, okay? So this is a failure kind of swing, if you would like, or a failed rebound, okay? So it didn't manage to rebound accordingly. So you take this with a grain of salt. If we do not treat this like whenever you see a break above the upper bound or the lower bound, that means going short or long, depending on the situation, okay? See other stuff, add more stuff to your chart to get this kind of indication, okay? Clear a kind of view by not going blindly using only one tool and expecting to have some sort of high profitability chance, okay? So I'm going to stress this a million times. Where did we left off? Okay. I think I covered every one of these. Let's just go over quickly because we're running out of time. So Bollinger Bands, the technical analysis tool implemented by John Bollinger. Yes, we said that. Having evolved from the concept of trading bands, that was a prior kind of tool. Difference between trading bands and Bollinger Bands is that trading bands are not dynamic in nature. That means they do not adjust if you have a volatile kind of period. Is the moving average plus a specific number of percentage or up and down. So for example, it's a moving average plus 5% and moving average minus 5%, and you get two bands. They're not dynamic, they're fixed compared to Bollinger Bands, which are actually using that deviation or that volatility to their benefit, okay? So Bollinger Bands can be used to measure the highness or the lowest of the price action relative to prior trades, okay? The components are end period sample moving average. Most of the time it's 20. Okay. Upper band, it's the end period, which is the 20 plus the K is the two standard deviations. So 20-day MA, okay, plus the two standard deviations. That's what the upper bound is. The lower bound is the same thing minus this. Okay, that's it. So N, K are 20 and 2. This is N and this is the K. No need to know this anyways. So a default choice of the average is the simple moving average, but you can do exponential as well. So mainly because it's gaining momentum in recent times, and the EMA is more sensitive to price movements compared to the composite, to the simple moving average. Okay. Enough said. So the use of Bollinger Bands varies among traders. So some traders like to buy when the price touches the lower bound. For example, this period right here, lower bound, you tend to buy. Okay. And exit the trade when price touches the moving average or the center of the line. So that is your target. Okay. This is a trade. Or as I said again, maybe the other one is this. Okay. So that's other traders sell when the price breaks above the upper band. This kind of case right here. And and anticipating the correction on buy when the price falls to lower band. Okay, mentioned this many times. So when the bands lie close together, there is low volatility, and that is a very nice signal for you to be looking at, because after brief or maybe long periods of low volatility, something happens, and this is in a sense the precursor to catching the move early. Okay, you know the phrase early bird catches the worm. How something like this. Goes along those lines. I'm not familiar actually. So in low volatility periods, it's much nicer to pay close attention to, because you can actually capitalize upon the rapid rally of the move when, in, if, and at the time it breaks, compared to a move that has already happened. So after a high volatility, pretty much uncertain where the market is going to head towards to next. Is much more uncertain and volatile. So low volatility is a precursor to catching a trade early on. So please look out for those. Lovely. If you learn how to spot them, you can actually capitalize on the entirety of the move and make much more money on that. So when the bonds are far apart, however, there is high volatility as the price is indicated. Okay, so you have also bands that only have a slight slope and lie approximately parallel for an extended period of time, where the price action is oscillating up and down between these bands. Those could be used or could be classified as a channel, and this is the channel right here. Okay, this is the period we just talked about. The low volatility, not moving particularly to any direction. That's relative. This can be deemed as a channel, and again, the channel does have its own interpretation. Okay, we talked about this in the prior webinars. Okay, how to use these kind of channels as early indications, or actually trade upon them within the channel. Okay, so traders are often to incline both the use of Bollinger Bands with other indicators, as it's true for other indicators as well, and we look for confirmation. So if you use an oscillator like Bollinger Bands, will often be coupled with a non-oscillator indicator like sharp patterns or a trend line. This lousy attempt of mine of drawing a trend line, which is a downwards. Apologies, it's not straight, I know, but it gives you an indication of where the market is headed at. Okay, so you can use many other different things in order, at the end of the day, to confirm the recommendation of the Bollinger Bands, and you have greater evidence that the band's forecast is correct. Okay, use other stuff as well, please. So, okay, let's have another 10 or 15 minutes tops on the RSI, and then we're done. Sorry for extending it that much further, guys. So the RSI is the final technical indicator that we're going to look at today. Moving averages, Bollinger Bands, now RSI. So the RSI, or the Relative Strength Index, measures the speed and change of price movements. Okay, this is what you need to know. How fast and what kind of direction does it have? Okay, or whether it's going to have a change. Okay, so it measures the speed and change of price movements. 14 periods is the default. You can do 20, you can do 7, you can do whatever you want. Default, however, is 14. Okay, so, and there is a reason for this. When we're talking about the commodity cycle, it tends to match that kind of thing. It also has to do a lot with futures trading. We're not going to go into that. How we came down to the 14 period, never mind. The point is to understand what the RSI is telling you. Okay, so it ranges between 0 and 100. Okay, so it's again an oscillator, and alerts traders for overbought and oversold conditions, as the stochastic indicator does. And we have, as we just said, we have 100 being the overbought. Okay, you have the 70, you have the 50, you have the 30, and these are not fixed, by the way, except 100 and 0. Those are fixed for sure, and the 50. 70 and 30 are adjustable, okay? But those are the levels. So 0 is oversold conditions. Well, that means, if you're not understanding what that is, that means there is a lot of bearish or extreme bearish sentiment. That means everyone is, for some reason, pessimistic about this, about the future of this instrument. Finding out a value, RSI value of 100 and 0. I have not personally seen that in 7, 8 years now. I think it's a myth. Maybe someone else has seen it. Most of the times you get something like 95, 96, 7, whatever that is. And the lowest I've seen personally is something like what, 9. But yeah, that means the point to understand is that it's a gradient, there is a scale, there's a spectrum. So the higher the value is, that means there is a lot of bullish sentiment around this. I mean, for some reason, everyone wants to buy that thing. Okay. Whereas when you have a value closer to 0, let's just say 5, 9, 10, whatever that is, there is a lot of pessimism and people, for some reason, want to get rid of that instrument for whatever the reason that is. Okay. So most of the times these are extreme values, 1 and 1, 2. So they are helpful, but most of the times you're going to see price action revolving around these areas. Okay, maybe 20 and 80, but the defaults are this. So the 50 is the midline, and we see midline, pretty much nothing happens here. So if you see RSI value gyrating around the 50 level, that means neither the bulls or the bears are in control of the move. That means nobody cares about this thing. It's going to move, and you're going to see that in a price action. It's probably going to move in a sideways kind of manner. Instrument is not going anywhere, either upside or the downside. However, when you see price action leaning, or RSI value, excuse me, leaning between 50 and 70, that means there is enough or some slight bullish kind of tendencies. That means the bulls are outweighing the strength of the bears at this kind of at that point in time, and most likely you're going to see the price action heading to higher ground. There are divergences, but most of the times we're talking about some sort of convergence. And readings between 50 and 30 are what we call the bearish ones. That means the bears are in control. That means the price action is being driven to lower ground, and the RSI is telling you just that. So 50 midline is sideways. Yep. Or inactivity, in other words, or indecision. That's one way to conceptualize it, the 50. 70, values between 50 and 70 are bullish, and values between 50 and 30 are bearish. Obviously, the extremes, if we're looking for something between 70 and 100, that is super bullish, and something between 30 and 0 is super bearish. That means the price action is going to fall at a much faster pace if you were looking between 0 and 30 compared to 0 to 30 and 50. Okay, so it's a gradient scale. I think you get the point. So we just outlined the parameters. This is the scale. Okay, and what are how do you read this kind of scale? And you're going to see this in a visual illustration soon. So many use the 50 midpoint to distinguish between bullish and bearish momentum, and this is what we do care about. This is what RSI is. It's a momentum oscillator or indicator. Okay, so the rally strength index is a technical indicator used by technical analysis of financial market. Blah blah blah. Yep, it is intended to chart the current. Okay, to the point, historical strength or weakness of an instrument based on the closing prices. Rings a bell. Closing prices, moving averages use that as well, of a recent trading period. So the RSI is classified as a momentum oscillator, measuring the velocity, in other words, the speed of how fast something moves, and the magnitude of directional price movement. How fast, how strong those kind of moves are. This is what RSI is telling you. That's why it's a lovely indicator to use on your charts, because it uses momentum. Momentum, you can use pure momentum as well, but RSI, it's a little bit more sophisticated, much more clear cut. Yeah, may I say that? Okay. So momentum is the rate of the rise or fall in price. Okay. So it's a percentage change of price action. Okay. How fast is a delta? Is a change of how quickly the price action is evolving either to the upside or the downside. So the RSI computes momentum as the ratio of what? Higher closes compared to lower closes. Okay. Again, compiles information about the past. Okay. So instruments that have more stronger positive changes. For example, you have an instrument that has rallied 7 days and then came back 3 days. Okay, so 7 days are positive, 3 days are negative. You have a positive RSI value, obviously, because you have 7 days and then 3 days of pullback. you clearly see that the bulls are in control of this move. If you have an instrument that past 10 days or 14 days, whatever that is, the past 10 days have closed in the reds, that means moving south, and the 4 days were in the green, that means obviously the ratio between the losses, the losing days and the winning days is higher. For the losing days, that means the bears were in control. RSI value is going to be negative. Okay. So again, it's not telling you what's going to happen in the future. It's telling you what is happening currently, but also what has happened in the recent past. Okay. It's not a leading indicator. Okay. So RSI is most typically used on a 14-day time frame, measuring a scale from 0 to 100. We just mentioned this. And the high and low prior points are 70 and 30. You can do 80 and 20, much like Bollinger Bands we just said. With 2 standard deviations, you do 3, you capture a much more volatile price action, and you look for the 1%, the extremist of the extreme kind of moves. Same thing can be applied here for the RSI. 80 and 20 is a second alternative. 90 and 10, it's a much more extreme kind of threshold areas that you could use as settings on your RSI. Okay, so because they occur less frequently, but at the end of the day, they tell you this. Okay, so visualizing RSI. What else? How much? I have 3 slides. Yeah, let's go quickly. So this is a visual illustration of the RSI and price action of what do we have here? Dollar, yen, weekly chart. Okay. As you can clearly see, what do we see? RSI is the yellow line below, by the way. Okay, different channel, different box on the panel below. So we see this area, price action revolving around the 50. Neither the bulls, nor the bears were in control. Price action pretty much does nothing. Oh, it does something, moves to higher ground, but still has nothing volatile to it. Okay. Then we have some sort of swing. And from here onwards, hopefully you can see the dotted line in the middle is the midline, the 50. Okay. Let me just mark it out of the way. I know it's not on top of it, but come on. So what do we see here? RSI falling. Okay, so it's below the midline. Okay, that means bearish sentiment. This is the 30, by the way, down here. Okay, that means price action in this kind of area was between 50 and 30. Okay, bears are in control, slight bearish momentum. You can clearly see that from price action. If you don't, basically first you look at price action and then RSI. The RSI confirms it. If it confirms it, perfect. If it has divergence, which is another, the most important aspect of RSI, in my opinion, is spotting those divergences. Gives you valid and clear signals. And you know what? We should be short in this kind of instrument from this period onwards. Okay, that is the other way of doing it. But also, please note that on the chart we have Bollinger Bands, the blue line here, 1, 2, and 3. We also have moving average. And we're going to talk about the convergence. So here, by the way, crossover. What is a crossover? This is a bullish crossover. Do the other indicators confirm that or not? You will see. For the time being, let's revert back towards the RSI reading and interpretation and deduction, if you would like. So from here onwards, we have seen a brief period of the RSI being between 30 and 50. Bears were in control. Price action confirms that. But afterwards, we see the break above the 50 line, and we move on from bearish territory to bullish territory. And you see how quickly or how fast the line just switched upwards. That is the speed of change. That is speed and change, but also the velocity and magnitude of the movements. Okay, so stronger momentum. If you see the slope of the RSI being kind of vertical, that means there is acceleration. There's quick. There's a lot of people in there pushing the price action in this kind of case to higher ground. So the slope of the RSI does matter. The fact that the RSI moved from negative, from bearish territory into bullish territory matters. Okay, so these are the stuff we're looking about. But at the end of the day, we also care about the extremes as well. So this is the 70, the 50, and the 30. So we have now ventured into bullish territory. Price action up, surges to high ground, and then we see a hit of overbought conditions. That means a lot of people are buying this thing. And what did we say about overbought and oversold conditions? We extrapolate there's going to be a reversion towards the mean. In this kind of case, it was a slight one, but it was there indeed. And you can clearly see that RSI, yes, crossed the 17 barrier, or the oversold kind of conditions, went up to 75, whatever that is, I can't pretty much tell, and then returned back, but it did not go into negative territory, into bearish territory. The bulls remain in control, but their momentum, their strength kind of weakened. Still, the bulls are in control. So this is another lovely signal that this is a long play still, because we didn't see RSI coming down here. We didn't see the shift of the initiative from the bulls to the bears. Yes, the bulls push the price action to high ground. We have reached oversold position or conditions, but the bears entered the picture and dragged down the bulls. They put some sort of pressure on the bulls, but they did not take the initiative. The initiative remains with the bulls. That means the momentum has slowed, but it's in the favor of the bulls. That means you stay long in this kind of case, in those kind of games, excuse me, in this kind of place. And from here onwards, we see RSI kind of moving within the 50 and the 70 bullish conditions. And yet again, look at this surge right here. Okay. You see, yes, it moves to high ground, the price action, but at a slower pace. But at this point in time, okay, volatility in short, and you see this. Okay, so a higher high break above this kind of level at this point in time. Confirmation, bulls are indeed in control, and we have reached oversold conditions. But yet again, pulls back, doesn't go below the 50. The bulls are in control, and you see trial after trial of pushing the price action to high ground, mainly because you have super good bullish sentiment and the absence of the bears. The bears are not there to place a check on the bulls, and the bulls are by themselves pushing the price action to high ground. Now, for whatever reason, we're not going to go into the fundamentals. We're talking about dollar yen, has definitely something to do, or not something, has everything to do with central bank monetary policy decisions or the divergence or the difference between the Federal Reserve and the Bank of Japan. We're not going to go into specifics. But yeah, let's stick to the technicals. Again, price action stays in bullish territory. Bollinger Band confirms that. Also, we have a crossover, a bullish crossover of the moving averages. See, this is the moving average, the long one. This is the short one. We see here what we call the bullish crossover, or in other words, the golden cross. Crossover. Okay. So this is a second, and this is the third confirmation that the bulls are indeed in control. The fact that we see RSI values remaining above 50 and then targeting once again the 70 level and breaking above them. Look at this oversold conditions for a sustained period of time, and see how fast the price action has moved from there onwards. Okay, you see how we have a value of what, 90, maybe it's 88, 87, whatever that is. Superb bullish sentiment, superb bullish momentum. What's the reason of going short in this kind of scenario? If you have missed the boat, you could have entered somewhere in here in these kind of pullbacks when the RSI came back. Okay, you see consolidation above the 70. Again, pullback confirmed by the RSI. So it's giving you real-time information about what to do. Okay, you see how important this is? Because it gauges momentum. Okay, and by judging how fast the price action is moving, how strong the move is, how violent the price action is, how volatile the price action is, you can use that to your advantage by studying the RSI as an indicator. Okay. From there onwards, super bullish. In a sense, this is a lovely picture point of absence. I'm not going to write the whole thing. Absence of sellers. So bulls were partying hard during this kind of period because we have not seen anyone going short on the dollar. Actually, everyone was long on the dollar and pretty much short on the yen in this kind of case. So we're talking about dollar yen. This is a strength of the dollar. It's nothing to do with strength of the yen. Mainly has to do a lot with the weakness of the yen, actually. That's why we have seen this radical move, but also see the confirmation by the moving averages, by the Bollinger Bands right here, by the RSI down here, and let's just say by this trend line I just drew again. Okay, so we have 4 or 5 different indications telling you exactly the same thing. Nothing else to do. Nobody goes short in this kind of environment when you have 5 out of 5. Okay, 5 out of 5 indications telling you you should go long, go for it, and wait for the period where you're going to see where the shift in the trend has taken place. Okay, so moving on. Principles of RSI, and okay, we have to close this session, guys. Sorry for taking too long. But principles are when price moves up very rapidly at some point in time, it's going to be considered to be overbought, what we do care about. Likewise, the price falls very rapidly at some points is considered to be oversold. So we're talking about conditions above 70 and conditions below 30. Okay, so it gives rise for a potential reversal scenarios. Again, reversion towards the mean, that kind of concept we just talked about. In this kind of case, never happened. Okay, maybe it's gonna take place sometime in the future after that, but for the time being, this is not telling you anything about a reversal. This is confirmation after confirmation that price action is gonna head to high ground. The level of the RSI is a measure of the stocks or instruments in general. Don't take it just for stock. Recent trading strength. And remember, it's a lagging indicator, not a forward-looking, not a leading indicator. Compiles information about the past. Okay, but momentum aspect of things is giving you indication about currently what's going on. Okay, so the slope of the RSI is directly proportional to the velocity of the change in trend. So the slope meaning this, okay, how swiftly or how quickly or how sharply has risen is a clear indication of how fast the trend has is changing. The distance traveled by the RSI is proportional to the magnitude of the move. Okay, and see how it jumped from the 50 to the 70 within what? I don't know, 2 weeks, because the weekly chart. The faster it goes, the sharper the line is, the steeper the slope, the more volatile the move is in that kind of direction. Those are, excuse me, the clear signals that we do look out for as technical traders or technical analysts. Okay. So it is believed that tops and bottoms are indicated when the RSI goes above 70 or drops below 30. In this kind of case, some sort of significance or value was given by this. So this is the top, is above 70, and we see after this a sharp drop, pullback. Again, not as high as before, and this is another indication. This is what we call a divergence. Lower high, this is a higher high. Okay, let's not go into specifics. We don't have much time, unfortunately. We're going to cover that in depth in the RSI webinar. And again, rapid fall of price action, pullback. Okay, RSI is telling you these things. Okay, so traditional RSI readings rating the 70 are considered to be overbought. Yes, below 30 are oversold, and between 30 and 70 considered to be neutral. The 50, with the 50 level as a sign of no trend. Okay, so periods around 50, no trend. Oh, sorry, Ryan, you have a question. Is that daily chart, hourly, or actually this is a weekly chart? And this is an old example. If you look at dollar yen, it has some sort of volatile movement recently as well. I need to update my charts actually. We'll do. Yeah, it's from 2021 when we saw the whole major thing coming up with inflation and central banks hiking rates and all that kind of stuff. The fundamental aspects of the things were there, which drove these kind of fuel, this kind of move. It's not actually technical. We do see the technical aspect of it, but the reason why we see this kind of moves is purely based from fundamental. And we have discovered this many times in the past. Okay, so overbought and oversold conditions. Yes, we mentioned this. Analysts consider also failure swings above 70 and below 30, which are strong indication as well. What we mean by failure swings is that imagine that RSI hits 76 and then pulls back to 72. So pick and then once again, and then once again rebounds to 77. So if it fails below the 72, we'll consider this a failure swing above 50. Let's see whether we can spot the failure swing. Maybe this one. This is a failure swing. Okay. So come back down from the 90s. It's a much more extreme scenario. Come back to the 70 and then rebounds from this. And this is reaction. Some people might have expected to see some sort of reversal taking place here because you know what? We over-exaggerated the move. But 1, 2, 3, 4 weeks of declines were halted with 1 week of erasing everything. Okay. Or was it 1, 2, 3 weeks? Whatever that is. These are 3 black crows, by the way. Anyway. And then you see a rebound once again, which failures. Okay. This is a failure swing. This to continue downwards. Okay. Finally, chart formations are areas of support and resistance could sometimes be more easily seen on the RSI chart opposed to the price chart. That's certainly true. And the center line of the relative strength index is the 50, which is often seen as both support and resistance line of the indicator. That's another way of using the 50. Okay. So if the relative strength index is below 50, means that trading instruments are trading losses are greater than the gains, obviously, because it compiles information about the past. If the RSI is below 50, that means the past majority of the trading days have closed in the reds. If it's above 50, majority of the past X amount of period of days have closed in the greens. Okay, pretty much self-explanatory. Guys, if you do have any questions, please send them through because we're way past our time. Apologies for these long chants and rants that have been going on today. Hopefully, I managed to convey the message across to you. Hopefully, you've learned stuff today. If not, please send me your questions. I'll be more than happy to answer them. If you want to watch this webinar, once again, it's going to be on YouTube pretty shortly. I'm not sure. I'm not the one that is uploading the stuff. Probably by the end of the day or maybe in a weekend. But yeah, this has been a brief intro into technical indicators. We have done moving averages, Bollinger Bands, and what was the last one? RSI. So fear not if you had some unclear kind of understanding of the whole thing. We're going to do webinars specifically on each and every one of those 3. These webinar was supposed to be much more structured and basic and more swift and quick and short. Unfortunately, I blabbed on for a lot longer than I actually expected. Hopefully that was for your benefit. So yeah, let's just keep it here. Thanks for watching, guys. Thank you for being here. Questions? No. Fine by me. So take care. Bye. Have a lovely weekend, and hopefully we're gonna catch you on to next Friday's webinar. Okay. I'm not sure what the topic is gonna be, but yeah, you can find out on the website. For the time being, take care, guys. Bye. Ciao.